Okay, let's dive in. We're looking at something that feels like a really big shift in how crypto projects raise money. Uh, Maybe even a new chapter starting for fintech.
Yeah, it looks that way. Coinbase, the big regulated U.S. exchange, they're rolling out a dedicated platform just for initial token sales.
And the buzz around this, it seems, is because it's one of the first, maybe the first real accessible way for regular U.S. investors, people like you listening to, get into these sales since everything blew up back in 2018.
Exactly. That year, 2018, it cast such a long shadow. It was just chaos back then.
Right. So this new approach seems very measured. Coinbase is saying, what, maybe one sale a month?
Something like that. They're starting with Monad, which is scheduled for mid-November.
Monad. That's one of those high-speed blockchain projects, right? An Ethereum competitor.
That's the one. High performance, parallelize. Choosing them first is probably a statement.
The statement how? Like showing they're serious.
Yeah, serious about the tech, but maybe more importantly, serious about projects that can navigate the regulatory landscape. It's all about this controlled ICO 2.0 approach.
Okay, so ICO 2.0, before we compare it to the Wild West, let's just quickly define terms. A token sale, we're talking about selling digital tokens, not company shares. Yeah.
Correct. These tokens represent some kind of value or rights within that specific project. And the really interesting part here is how Coinbase is structuring it. They're tackling head-on the two huge issues from the past.
Which were?
Well, first, you had the whales, these massive investors who just scoop up nearly everything early on. And second, the crazy price swings caused by people flipping tokens immediately for profit.
Okay, let's take the whales first. That concentration of ownership, how are they trying to stop that?
They've actually built what they call an anti-whale mechanism right into the process. It's about fair distribution.
How does it work in practice?
So the sale itself runs for a whole week, giving people time. But the crucial bit is the allocation algorithm they use afterwards. It specifically prioritizes smaller buy requests.
So like if I put in for $100.
Your $100 request gets processed, gets its share guaranteed before someone asking for, say, $100,000 gets their full amount considered.
Ah, okay. So it structurally forces a wider distribution.
Exactly. The aim is broad participation. Get the tokens into more hands, which is, healthier for the project long-term, better decentralization, less control by a few big players.
Makes sense. Okay, so problem one, fairness.
Yeah.
What about problem two? The flippers.
Yeah.
People buying just to dump immediately.
Right. The dumping, it just destabilizes everything right at the start. So Coinbase put in an anti-speculation measure.
Which is?
If you sell your newly acquired tokens too quickly after the sale,
Yep.
the system flags you, basically, and it reduces your allocation amount for future sales on their platform.
Oh, interesting. So it actively discourages short-term plans.
Yeah, it's a clear nudge. They're signaling they want investors who actually believe in the project long-term, not just quick speculators.
That really shifts the dynamic. And participation also means, what? A fully verified Coinbase account.
Yep, fully verified, meet all the U.S. compliance stuff, which is strict, and payment has to be in USDC.
The stablecoin. Okay.
But maybe the biggest shield for investors is actually aimed at the project teams themselves.
How so?
Projects launching, like Monad, have to agree to a strict 6-month lockup period.
6 months. Explain what that means exactly.
It means the founders, the team, insiders, anyone affiliated, they are barred from selling their own stash of tokens on exchanges or, over the counter for 6 months, unless Coinbase publicly approves it.
That prevents the team from just cashing out immediately after they raise the money, right?
Yeah.
Which happened a lot.
A lot. It was a major issue. So 6 months is a significant step for retail protection. Now, is it long enough? That's a debate.
Yeah, because in traditional VC, lockups can be way longer, like a year, even 2 years sometimes.
True. 6 months stops the immediate dump, which is huge. But, maybe some bigger partners could still sell relatively early. It's a balance.
A balance between safety and flexibility for the project, I guess.
Right. Longer lockups can sometimes make it harder for teams to use their tokens for things like collateral to fund further development.
Right.
So there are trade-offs.
Still, it's a world away from how things used to be.
Yeah.
Which brings us back to why. Why did this kind of public sale just disappear for like 5 years? We need to talk about that ICO boom.
Yeah, the silence wasn't an accident. It was a direct result of the market crashing and, crucially, the regulators stepping in.
ICO's initial coin offerings.
Ah.
That was the main game back then.
Oh, yeah. The scale was insane. First half of 2018 alone, something like $13.7 billion raised, often with little more than a white paper, maybe a vague idea, no actual product needed.
Just pure hype and promises.
Yeah.
I remember some crazy stories, teams just vanishing with millions.
Absolutely. Total Wild West. And that level of chaos, that's what inevitably got the SEC involved, the U.S. Securities and Exchange Commission.
And they came down hard, didn't they?
They did. They basically said, look, most of these tokens you guys are selling, they look an awful lot like securities under U.S. law, specifically investment contracts.
And they used that old legal standard, the Howey test, to figure that out.
Exactly. From way back in the 1940s, but still the benchmark. It has 4 key parts.
Let's break those down. It's important.
First, is there an investment of money? Well, yeah, people are buying tokens.
Check. Second.
Is it invested in a common enterprise? Usually, yes, everyone's investing in the same project.
Okay.
Third,
Is there an expectation of profit? Absolutely. People bought hoping the token price would go up.
right. And the fourth one, this was the kicker, wasn't it?
This was the one. Are the profits derived primarily from the efforts of others? Meaning, are you counting on the founders, the development team, to build the thing and make it valuable?
And for almost all ICOs, the answer was yes. You weren't buying a finished product. Precisely.
Yeah.
So the SEC concluded, boom, these are investment contracts, securities, and since they weren't registered, they were being sold illegally to the public. Massive crackdown followed.
But it wasn't just the regulators. The market itself imploded, right?
Yeah.
People lost a ton of money.
Oh, devastating losses. There was an analysis back then, I think Ernst & Young did it, reviewed over 140 ICOs. The findings were grim.
How grim.
Something like 86% of the tokens ended up trading below their initial sale price.
Wow. 86% lost money.
Yeah, and nearly a third, almost 30%, lost practically everything, just wiped out.
So you combine that massive loss of trust, the regulatory hammer coming down, and a general crypto bear market.
And the door just slammed shut on public retail ICOs, overnight almost.
Which brings us full circle to today and Coinbase trying to reopen that door, but in a completely different way.
Exactly. This is ICO 2.0. It's organized. It uses regulated stablecoins like USDC. It has these built-in protections, the lockups, the fair allocation.
It feels like a real attempt to build structure, to bring compliance into this space, moving away from pure speculation.
Definitely. And that's why this is important. Even if you, listening right now, aren't in the US or planning to participate in this specific monad sale, it sets a new bar.
Okay, so let's distill the takeaways for everyone listening. What should people learn from this shift?
Well, takeaway number 1, use this as a new filter. When you look at any crypto project or token sale now, ask yourself those questions.
Like, is the platform reputable? Does the team have a proper lockup?
Exactly. Is the distribution designed to be fair, or does it look like whales get everything? Applying these filters can help you spot the riskier, less trustworthy setups. It reduces your exposure to the most obvious scams.
Got it. Filter for quality and fairness. What's takeaway 2?
Takeaway 2 is the big caution. This stuff is still risky. A regulated platform, these lockups, they reduce the risk of outright fraud, like the team dumping on you immediately.
Right, reduces that risk.
But it absolutely does not guarantee the project will succeed or that the token price will go up. It's still venture investing, essentially. High risk.
So the golden rule still applies.
Absolutely. Never, ever invest more than you are genuinely prepared to lose. Period.
Okay. And takeaway number 3.
This one's more about the mindset shift. By penalizing flippers and demanding lockups, Coinbase and others pushing this model are actively trying to weed out short-term speculators.
They want long-term holders.
They want people who believe in the vision, who are in it for the long haul. The market structure itself is shifting to favor that long-term investment mindset. If you see a project that seems designed purely for quick flipping, that's becoming a red flag.
So the market is maturing, trying to incentivize sustainability over just quick liquidity.
That seems to be the direction. This Coinbase move feels like a really important bridge, connecting those hard, expensive lessons from 2018 with a more grown-up, compliance-aware future for crypto fundraising.
It definitely shows a push for structure, for control, which feels necessary for long-term health. But okay, let's end with a thought to chew on.
Go for it.
This new era, this ICO 2.0,
Yeah.
it's all about safety, fairness, control. Taming the Wild West, right? But does that taming, that reduction in volatility, and maybe even the crazy potential upside, Does it risk stifling some of that raw, unpredictable, maybe even chaotic innovation that defined the early days?
That's the million-dollar question, isn't it? The price of maturity. Are we potentially filtering out the next truly disruptive, weird idea because it doesn't fit the mold?
Yeah, something to definitely think about as we watch this new phase unfold.